Modern finance operates in the dark. It is silent, frictionless, and invisible. Trades worth billions flash across the globe in fractions of a second, executed by algorithms living inside air conditioned server farms. A century ago, the machinery of American finance consisted of human bodies operating directly in the mud of lower Manhattan. The system was loud, physical, and profoundly chaotic. Before these markets were institutionalized, they functioned as a raw democratic mob, an exchange without walls or a roof, operating in the literal gutters of New York City. To understand how modern Wall Street manages risk today, we have to look back at the physical space where risk was originally banished. We have to go outside. By the late 1800s, the New York Stock Exchange had become the nation's dominant financial gatekeeper. It operated strictly behind heavy stone pillars, demanding high listing standards and rigorous financial disclosures from its members. This gatekeeping shut out hundreds of emerging businesses. Speculative gold mines, unproven Pennsylvania oil drills, and untested industrial startups were deemed too dangerous for the elite trading floor. Because these companies still needed capital, brokers created a parallel market right on the street. Gathering on the curb near the New York Stock Exchange building, they formed what became known as the Little Board or Curb Market. The mechanics of this outdoor exchange were defined by low barriers to entry. Anyone with a loud voice and good lungs could walk up to the curb and act as a trader. This physical divide separated two versions of capitalism. Institutional wealth was protected behind masonry walls, while speculative, unregulated trading was left exposed to the elements. Executing thousands of secure trades in the middle of a noisy thoroughfare required a specialized communication system. Without digital tickers or electronic networks, the curb turned to human bodies as technology. At street level, brokers used a visual identification system. They wore garish, brightly colored hats and coats, acid greens and oranges and loud stripes so their colleagues could spot them within the dense, swirling mob. Above them, brokerage houses rented offices overlooking the street. They stationed clerks in the windows, often with their legs dangling over the high-rise ledges, to maintain a constant line of sight with their traders on the ground. These clerks used a secret language of complex hand gestures to securely relay buy and sell orders. This manual signaling cut through the deafening noise of horses and engines, allowing orders to travel from the office to the street in seconds. This was the precursor to the modern trading algorithm. Memory, physical endurance, and line of sight served as the infrastructure for the entire market. Trading never stopped for the environment. Brokers closed deals through blizzards, heat waves, and the hazards of active city traffic. This unregulated space allowed for lightning-fast funding of critical new industries, but it also invited rampant fraud and speculative bubbles that could wipe out investors overnight. Despite the chaos, the elite New York Stock Exchange relied on the curb as a seasoning market. Risky new stocks stabilized here before admission to the big board. 80% of curb orders originated from New York Stock Exchange brokerages, allowing the establishment to trade speculatively while technically following institutional rules. The financial elite didn't want to destroy the chaos of the curb. They actively used it to test the boundaries of the American economy without dirtying their own hands. The turning point came after the Panic of 1907. The crisis sparked public outrage, and regulators began targeting the curb's lack of institutional safety nets and oversight. Emanuel S. Mendels, known as the father of the curb, realized the market had to change to survive. To avoid police crackdowns and government intervention, he pushed for a formal constitution and higher ethical standards. In June 1921, the curb market finally abandoned its outdoor identity. The brokers moved their operations into a new building on Greenwich Street, marking the end of the last open-air stock market in New York. The new building featured a bizarre architectural irony. The indoor trading floor was designed with artificial tiers and octagonal posts topped with globes, intentional recreations of the street stoops and lampposts the brokers were forced to leave behind. The move indoors signaled a surrender of their rogue independence. In exchange for shelter from the rain, the curb accepted the formal structures of institutional legitimacy. The enclosed market evolved rapidly, eventually renaming itself the American Stock Exchange, or Amex, in 1953. It became a monolith of modern finance, eventually being absorbed by its old rival, the New York Stock Exchange, in 2008. Even indoors, Amex maintained an innovative edge, pioneering the first exchange-traded funds in the 1990s as a continuation of its history of funding emerging industries. The physical marketplace on Broad Street is gone, but its internal mechanics are mirrored in decentralized finance. Both emerged outside established structures to serve volatile markets. Thriving on regulatory ambiguity, they attract the same visionary capital and high-stakes fraud that define the outdoor street market. The garish coats and physical grit have been replaced by silent code, yet the same human instincts for risk-taking that once filled the air on Broad Street continue to power every modern speculative frenzy. If this story gave you something to think about, you'll find more resources and related links in the description below. Subscribe if you want to see more stories just like this one.